Welcome to the 2020 AVCJ Private Equity and Venture Capital Awards. My name is Tim Burrows. I am Managing Editor of Asian Venture Capital Journal. Normally we present these awards over a gala dinner. For obvious reasons we cannot do that this year. However, the awards process itself was unchanged. The qualification period was the 12 months ending September the 26th, 2020. Nominations opened in August. They closed at the end of September. The AVCJ editorial board took all of the entries and we compiled long lists, and those were submitted to a panel of industry judges who made their recommendations as to who should be on the final shortlists. Those shortlists were made available to the entire private equity and venture capital community who could cast their votes on the winners. That vote had a 50% say in the final outcome, 40% was with the judges and 10% with the AVCJ editorial board. As always, we'd like to thank our judges for their input, and they included Alp Invest Partners, Asia Alternatives, Azimuth Asset Consulting, Future Fund, HarbourVest Partners, HQ Capital, the International Finance Corporation, LGT Capital Partners, Morgan Stanley Alternative Investment Partners, Pantheon Portfolio Advisors, Stepstone Group, and Unicorn Capital Partners. Now, 3 categories were not subject to a public vote. The first of those was the Responsible Investment Award, and that is given based on input from a separate judging panel comprising industry professionals with expertise in ESG. Once again, many thanks to those judges. They were Asian Development Bank, Empia, the International Finance Corporation, LGT Capital Partners, and Turnkey Group. The Operational Value Add Award, again, we had a separate panel comprising industry professionals with expertise in operations, and those included Alex Partners, Alvarez & Marcel, Anchor Strategic Partners, Bain & Company, KPMG, and PwC. Again, many thanks. Finally, the AVCJ Special Achievement Award is given at the discretion of the AVCJ editorial board with input from the private equity and venture capital community. Okay, our first category is fundraising. We begin with Fundraising of the Year Venture Capital. And the nominees: Blackbird Ventures Australia Fund 4, Eastern Bell Capital Fund 1, Insa Capital Partners 1, Lightspeed India Partners 3, and Chiming Venture Partners 7. The winner, Insa Capital Partners 1. So, Insa Capital Partners was established last year by JP Gann, formerly of Chiming Venture Capital Partners. The firm focuses on consumer internet deals. They closed their debut fund on $351.9 million in October 2019. The target was $300 million. JP Gann recorded this message.
I'm JP Gann, founding partner of Insa Capital. It's a great honor to receive AVCJ's VC Fundraising of the Year Award. We raised $352 million relatively quickly last year. So first of all, I would like to thank all of our limited partners who have placed tremendous trust in us as we are a first-time fund. We will not let you down. In the past year, despite the COVID-19, we invest in 11 companies. My partners and investment team have worked very hard, hand in hand with some of the great entrepreneurs during the pandemic. I would like to thank my partners and the entrepreneurs who we have worked with for the long-lasting entrepreneurship. I'm confident the great entrepreneur spirit will survive and outlast the virus. We will continue to empower the future great. Finally, I would like to thank AVCJ for your support throughout my career. I would like to share a little story. 2 years ago, I was nominated to be VC Professional of the Year. Tim Bureau called me, asked me to go down to Hong Kong. I did go, but I did not receive the award. Last year, I was nominated again. Tim did not call me. No one called me. So I didn't go down to Hong Kong. But nevertheless, I received the VC of the Year award jointly with my Chiming partner, Nisa. So this year, it's a virtual reward ceremony, but it does give me a chance to show AVCJ my appreciation in this recording for the record. Thank you.
And we move on to Fundraising of the Year Midcap. This is for funds below $2 billion in size. And the nominees: Advantage Partners 6, Ascendant Capital Partners 3, Newquest Asia Fund 4, Pacific Equity Partners 6, and VIG Partners Fund 4. And the winner? Ascendant Capital Partners 3. So Ascendant Capital Partners, which focuses on mid-market China deals, closed their third fund at the end of 2019 with just over $1 billion in commitments. They closed their previous fund at $600 million in 2015. Heidi Lue of Ascendant came in and collected the award and said a few words.
Congratulations.
Thank you very much. Thank you to AVCJ for recognizing the success of our Fund 3 fundraising. We are very grateful to all of our supporters, particularly investors who've been with us since the beginning through Funds 1, 2, and 3. It has been great working with you. We're very glad to report that we've had excellent pacing in terms of our exits, deployment, and also upcoming exit events. We look forward to working together with you. It's been a pleasure working on recent co-investments, and there will be more to come.
Fundraising of the year large cap, fund size $2 billion and above. The nominees: Carlyle Japan Partners 4, Hahn & Company 3, MBK Partners Fund 5, Primavera Capital Fund 3, and SSG Capital Partners 5 plus Sidecar. And the winner? Carlyle Japan Partners 4. So the Carlyle Group closed their latest Japan fund in March 2020 on 258 billion yen. It is more than twice the size of its predecessor. Kazuhiro Yamada, head of Carlyle's Japan Buyout Fund, recorded this message.
Hello everyone, I'm Kazu Yamada, head of Carlyle Japan. I'm very honored to receive AVCJ Large Cap Fundraising Award of this year. We kick off the fundraising from March 2019, and it took less than 1 year by the final closing. We visited more than 100 global investors with a variety of regions, and we felt a high expectation of a potential growth of Japanese PE market. We raised 258 billion yen fund, which is the largest fund as a Japan dedicated fund, and we are very unique position to capture both corporate carve-out and succession opportunities. We closed most deals and one of the largest team in Japan as a global private equity. I express appreciation for long-time support from our investors, and I appreciate for our all colleagues to support this fundraising. I also express congratulations to all winners of AVCJ Awards. I hope everyone's safe and healthy. Thank you.
I'm now joined by Doug Coulter, a partner with LGT Capital Partners based in Hong Kong, and we're going to talk about the Asia fundraising environment. Doug, thank you for joining me.
Thank you.
Obviously, at the start of the year, fundraising just completely slowed down. What we've seen since then is a bit of a resurgence to pre-COVID levels, more or less. Mm-hmm. But that resurgence has not been equal. Can you sort of take me through that sort of flight to familiarity?
Sure. Well, you're right. I mean, fundraising is back to 2019 levels if you annualize Q3. And clearly, if you look at some of the managers in the market who've put really good numbers on the board historically, have very good brand names, they've done very well. So you're right, it's a flight to quality, and it'll probably continue for the next couple of quarters. I think post-COVID, sometime in 2021, it'll be very interesting to see whether first-time managers and others who have struggled a little bit during 2020 can come back.
So if you were a first-time manager right now, should you not bother launching? Should you just try and do deal by deal? Should you warehouse some deals?
I think managers are doing different things. We're certainly seeing a lot of managers doing deal by deal, and I think that can be a very good way to familiarize yourself with the LP community, build strong relationships. Others have pulled their fundraisings, and others have just decided to push ahead. I think it really does depend on the geography and the strategy.
Mm-hmm. And so in terms of geography, I mean, are there certain areas where fundraising remains really quite robust?
I think China, like always, remains quite robust. So if you look at Chinese fundraising, around 70% of private equity fundraising since 2016 has been for China-focused managers. And that does remain definitely not the easiest fundraise, but that's where we're seeing the most capital raised. If you're coming, for example, from India, there might be a very small handful of managers with very good historical numbers that are doing one and done closes, but for the most part, it's much more difficult.
And how much of the money in China is going to venture capital?
An increasing amount. So it's not just the number of funds, but it's the size of the funds. So we are looking at very large volumes of money flowing into that part of the asset class, which obviously, from a backward-looking returns perspective, makes sense, but it's something we need to keep an eye on going forward.
So I think it must have been maybe 4 years ago now, we started seeing these sort of top-up funds. And now that seems to be pretty standard for everyone in the market.
That's right.
What are the concerns that come with that?
The concerns are, first and foremost, raising too much capital. We understand why managers do it, and often it does make sense. And if you have a scaled team and a reason for doing it, we have no trouble backing those sorts of funds. But I don't think there's there's no reason for everybody to be doing it, for sure.
Is there also a concern that people are not realizing as quickly as perhaps they should? So you could have a manager that does a Series A and a Series B in its VC fund, does Series D, maybe Series E in their top-up fund, and they're sort of sitting on this position which is enormous, and maybe it's listed and so it's liquid, but they're not sort of exiting it. And are you seeing enough managers really sort of bringing the money back?
Well, but that's been one of the issues with Asian private equity in general. Luckily, according to AVCJ data and our own, the pace of exits has been increasing dramatically over the past 10 years. 2019 was a drop-off, and 2020 has been a very bad year for exits. We're hoping that's going to bounce back in Q4 in 2021.
The other geography where we are seeing pretty robust fundraising is Japan. Middle market, and I guess what you now call the big middle market, the upper middle market. There are people raising money there. What are your sort of feelings about Japan? I mean, why is it now a hot geography?
I think it's partly diversification. China has become such a big part of LPs' portfolios. Japan has been a market that has put pretty good numbers on the board. It provides diversification in terms of more buyouts as opposed to the growth markets of China and India. And there are an increasing number of managers there that people can allocate to. So it does make some sense to us.
So on that basis, if I was looking at sort of diversification, easing my reliance on China, would I not also be looking at Southeast Asia? So you think about that sort of broader economic trend where you see these supply chains moving perhaps to Southeast Asia. Should that translate into, I guess, a deeper GP pool in Southeast Asia?
Well, interestingly, and again, looking at the AVCJ data, there are a very large number of managers in Southeast Asia. And a lot of them are first and second time fund managers. The problem is not too many proven fund managers, but at the end of the day, there's a big pool of managers to choose from. Many of them are in the market right now.
Would you be more comfortable accessing Southeast Asia through a pan-regional fund or through a sub-regional fund?
I think both can work. It really depends on your top-down strategy, what you're more comfortable with. One thing we always say about Southeast Asia, there have been some very, very good deals done in that region on a case-by-case basis, but fewer managers who've put together really good returns on a fund level and done it consistently over a long period of time.
We're here to talk about fundraising, but we probably should also talk a little bit about secondaries as well. There's a lot more capital looking for deals in that space. Are you also seeing more opportunities?
Certainly opportunities. We've never been busier on the secondary side than we are now. That being said, deal volume is down dramatically in 2020. That's because the first half was almost a write-off in terms of secondaries deal volume in Asia, according to the data we've seen. That being said, Q3 number of secondaries closed is up pretty dramatically, and we are expecting a very, very strong finish to the year.
And what particular themes are you seeing within secondaries? So are we talking single asset continuation? Are we talking fund restructuring?
Yeah, what we're seeing a lot of, and everybody else in the market is seeing as well, are GP restructurings. That's really been key. And I think one of the reasons for that is most likely that we're seeing a lot of funds raised between 2007 2009, when a lot of money was coming into Asian emerging markets, just pre-GFC. And a lot of those funds have reached end of life or close to end of life, and they need a solution. And that's where secondaries firms can come in and help find a solution.
Doug, thank you very much indeed.
Thank you.
Okay, we move on to the Deal of the Year categories and we start with small cap, and that is for an equity commitment below $50 million. Our nominees are AI Park, Fujitsu Interconnect Technologies, Shuken Technology, Tani Group and XYZ Robotics. In some of these cases there are quite a few investors in each deal, so I'm not going to read out all the names now. You can find them on the awards website. And the winner, Tani Group. So Tani Group is an Indonesian agricultural technology startup. It closed an extended Series A round of $17 million in April 2020. The round was led by Open Space Ventures and Intudo Ventures, and it also featured UOB Venture Management, Vertex Ventures, BRI Ventures, Tenea Capital and Golden Gate Ventures. Shane Chesson of Open Space Ventures recorded this message.
Good evening everyone, Shane Chesson here from Open Space Ventures. Thank you so much to AVCJ for the recognition. Thanks to the judges, thanks to the voters. Very proud to be up here tonight to talk to you about Tani Group. Tani Group was established in 2016 by Ivan and Eka and a very hard-working team. You can see them here in their black t-shirts, leaders in agri-tech and leaders in fashion. Their mission was to use technology to empower Indonesia's agricultural sector, barely touched by digitalization in the past. And it's subject to a number of issues. Too many intermediaries driving inefficiencies, poor logistics, and a lack of proper demand-supply matching. Tani Group sets out to solve this through technology. They put in place data-driven systems to reach to multiple sources of supply, multiple sources of demand, and create the best match. We've been invested since leading the Series A for Tani Hub in 2018, and we're proud to say that during COVID, the company has performed very well. We've tripled revenues, and we've moved into an EBITDA positive position. I want to thank again Ivan and Eka for their contribution. I want to thank our co-investors who've been an incredible team on this transaction. It's been great to work with all of you guys. And also I want to thank AVCJ again for their support of the industry and for this award.
Deal of the Year Midcap. Equity commitment $50 million to $199 million. Our nominees are Airwallex, Kakao M, Meow Show Doctor, Perfect Diary and Unacademy. Once again, for full lists of investors, check out the awards website. And the winner, Perfect Diary. Perfect Diary is a Chinese cosmetics brand. It raised $100 million in Series D funding in March 2020. The investors were Boyu Capital, Gaorong Capital, Hillhouse Capital, Hopu Investment, Longhu Capital, Tiger Global Management and VMG Partners. The reported valuation was $2 billion. Since then, Perfect Diary has filed for an IPO. Ray Han of Gaorong Capital and Sarah Dai of Hillhouse recorded these messages.
Hi, this is Ray Han from Gaorong Capital. Thank you, AVCJ, and congratulations to Perfect Diary for being awarded the Midcap Deal of the Year. Perfect Diary believes that everyone have a fair chance to pursue beauty and become a better self. The slogan is unlimited beauty. I'm inspired by this goal and believe that they're in the right way of making it happen. Gaorong Capital is honored to become an early investor of Perfect Diary. I still remember the first meeting I had with David and Vincent. I think it's about 2018 February. I'm so impressed by their vision and value. Actually, from what I have seen, every time there is conflict, the company always chooses the customer interest and stand on the long-term win. We believe that now is the best time for entrepreneurship in China, and I sincerely hope that there will be more and more world-class companies born from China and serve the customers all around the world.
Hi everyone, I'm Sarah Dai and I'm a managing director on consumer team at Hillhouse. We are very honored and at the same time excited to receive Deal of the Year award in the mid-cap category for our investment in Perfect Diary. Perfect Diary is a leader in the rapidly evolving China beauty market since its inception. We are proud to be one of their early partners along their successful journey. Thank you, AVCJ, and the broader PE and VC community for selecting us. We very much appreciate it.
Deal of the Year Large Cap, equity commitments $200 million and above. The nominees, Geo Platforms, Kuaishou, Metro Pacific Hospital Holdings, Virgin Australia Holdings, and Rumart. And the winner, Geo Platforms. Between April and June of 2020, about a dozen financial investors ploughed nearly $10 billion into Geo Platforms, which is a holding company owned by Reliance Industries, and it contains a number of apps, some broadband and cable services, and India's leading mobile carrier. The investors included Abu Dhabi Investment Authority, General Atlantic, Intel Capital, KKR, L. Catterton, Mubadala Investment, Public Investment Fund, Qualcomm Ventures, Silver Lake, TPG, and Vista Equity Partners. And we have Rupan Javeri of KKR who recorded this message.
We thank AVCJ in recognizing our investment in Geo Platforms as the large cap deal of the year. Thank you very much. Geo is truly a homegrown Indian technology leader with a mission to digitally empower all of India's population of 1.3 billion. KKR's investment in Geo is really a testament of our commitment to not only India, but to the broader technology theme in rest of Asia Pacific. It also happens to be our largest investment in Asia till date. Once again, congratulations to everyone involved. Thank you.
Okay, so I'm joined by Dorothea Koo of Baker McKenzie. We're going to talk a bit about the deal environment. Dorothea, thank you for joining me. I'm sorry we couldn't do this at the awards dinner as normal.
It's very nice to see you again. Yes, it's a pity that we're not able to have the in-person awards dinner, but look forward to that next year. And we are very happy to be able to continue to sponsor the awards dinner. We really enjoy it.
Great. Obviously, the start of the year was quite heavily disrupted by COVID-19 and pretty much all deal activity sort of crunched to a stop. What we've seen then is a bit of a resurgence. Can you sort of give me your perspective on that? I mean, where did you first start seeing that sort of resurgence in activity?
I think we've seen a resurgence in activity maybe more recently in probably the last 6 to 8 weeks, I would say. Before that, I think indeed it was definitely much more inward-looking, focus on looking at the portfolio companies, financings, employees, and then we moved to a stage where people were looking at opportunities but not really ready to invest yet. And in the last 6 to 8 weeks, I think we've definitely seen much more real deal activity in terms of processes runs by way of auction, actually starting, clients participating in the process, looking very actively and putting in bids and offers or resumption of some of those auction processes. And also in terms of other areas like pipes, take private, and as well as specs. So I think definitely we are seeing more activity coming back to the table. And of course, I think we're also beginning to see some activity in the distress space, whether you're talking about acquisition of NPLs or really looking at businesses that are in distress, but along the gradient. And I think we'll expect to see more of that next year.
What sort of change have you seen in terms of process? Because obviously a lot of people are still, they can't travel, so they might have local teams on the ground, they might not. How flexible are GPs becoming in terms of what they are prepared to do without being there in person?
To your point, I think it does vary depending on the GP, because some of them would actually have people on the ground. So, for example, if you have a team on the ground in China, then the team could travel freely right within China. In other jurisdictions, being more challenging, like Southeast Asia, where you cannot really travel. That said, I think that based on my discussions with the GPs, I think a lot of them have been talking about, like, maybe in terms of deals, they have maybe met with the management beforehand, before the pandemic struck and before they were not able to travel. But in terms of the diligence, they were comfortable with then conducting it virtually, which I think it's the new normal for all of us, and also then through to the signing phase. But I think my sense is that you still have to meet with management in person. beforehand, before the deals are conducted.
Mm-hmm. And what about the sectors where you're seeing most activity? Because certainly, based on the deal flow I see, there seems to be a lot of tech, a lot of healthcare. But you sort of alluded that there might be some distress coming as well, which obviously presumably would not be in tech or healthcare.
Yes, indeed. I think in terms of the big trends, digital transformation is indeed one very big trend. So that would resonate with the tech aspect, and that is indeed something that we have seen quite a lot of. Data centers have been, one very hot topic that people have been talking about, looking at various, opportunities to invest in that space, and more recently as well, a lot of discussions around, from the China perspective, the possibility of being able to exit through the China REIT market with the new regime coming up as well. So I think that there's quite a lot of interest in that space, and logistics space as well, and also just the whole change in consumer behavior in terms of how people are, buying, from products like clothing to banking. So we're definitely seeing a lot more in the fintech space and tech as well. So a lot of tech interest, and health tech, or telehealth for that matter. So it does resonate with a lot of what you've mentioned as well. On the distress space, I think it's more, we've seen, airlines, hotels, and to a certain extent, the retail space as well.
When I look at the numbers, the investment levels actually are back to where they pretty much were pre-COVID. And this is Pan-Asia. Fundraising the same, exits are not. So exits are still down, and trade sales really aren't happening as much as people might like. Are you seeing a bit more activity now? Because I think, there was, if you are like a US strategic, it's going to be very hard for you to come to Asia and buy something. But are we now sort of seeing that the wheels loosen a bit?
I agree. I would say that definitely, we are beginning to see more activity in that space, including exits as well, and we are seeing that whether it's by way of auction, run by way of auction process or otherwise. So I think definitely we are seeing that coming back.
Great. Dorothea, thank you very much.
Thank you.
Exit of the year IPO, the nominees: ESR, IMAB Biopharma, SBI Cards and Payment Services, Venus Medtech, and Expa. And the winner is SBI Cards and Payment Services, which is a Carlyle Group portfolio company. SBI Cards is the credit issuing arm of State Bank of India. It raised 104 billion rupee in its domestic IPO in March 2020. Carlyle took 70 billion rupee off the table, and it retains an interest worth approximately 130 billion rupee. It originally invested 20 billion rupee in the company. We have Sunil Kal of Carlyle, who recorded this message.
Hello, on behalf of Carlyle, I would like to thank AVCJ for this recognition of SBI Card deal as the exit of the year. Any recognition like this, as we all know, is a reflection of hard work from a number of stakeholders, starting of course from the SBI Card leadership team, the parent bank SBI and our partner, the Carlyle deal team, and of course also the wider One Carlyle ecosystem that all helped partner together to help make this happen. This journey started in December of 17 and involved significant transition across a whole bunch of different dimensions, complete overhaul of the technology systems, use of new processes and AI-based algorithms to improve the servicing and the risk management system, the introduction of new products and co-branded cards, better linkage with the parent bank's customer ecosystem, and so on. The numbers speak for themselves, with the number of cards and the spend having nearly tripled since our investment less than 3 years ago. As I said, all of this is a result of the hard work of the SBI Card management team and indeed the whole SBI Card team. We at Carlyle are convinced that the best days of this business are still ahead, and this recognition of an important milestone, I'm sure, will be one of many more to come in the future. Thank you so much and have a lovely day.
Exit of the year small cap, and this is for investments that had an equity commitment on entry of below $50 million. Our nominees are Our Small Finance Bank, which is Chris Capital Partners, China Feihe, which is Morgan Stanley Private Equity Asia, Nexus Day Hospital, which is Mercury Capital, Paysense Services, which is Jungle Ventures and Nexus Venture Partners, and White Hat Junior, which is Nexus Venture Partners, Omidyar Network, and Owl Ventures. The winner, China Fei He. So Morgan Stanley Private Equity Asia supported a 147 million privatization of China Fei He in 2013, invested $30 million. They relisted the business in Hong Kong in November 2019, and so far Morgan Stanley has realised proceeds of 1.5 billion, and it still holds a stake worth approximately 2.6 billion. So it's sitting on a return, unrealised and realised, of about 138x. Morgan Stanley Private Equity Asia's Chin Cho stopped by for this interview. Okay, so I'm joined by Chin Cho, CEO of Morgan Stanley Private Equity Asia, who's going to talk to us a bit about the China Fei He exit. So, Chin,
yes.
Thank you for joining us.
Thank you.
So this investment, the initial commitment by Morgan Stanley was about 30 million. You've taken out 1.5 billion following the IPO in November 2019.
That's right.
And you still hold a position that's worth about 2.4 billion.
Yes.
So obviously that's a pretty spectacular return, realised and unrealised.
Yes.
Can you sort of take us through what sort of led to that, I suppose?
Sure. Well, first let me, on behalf of my colleagues Gao Yu and Kingsley, who led the transaction, and myself, thank you and the AVCJ for this award, and we're most proud to be recipients. The investment in China Fei He has been a very positive one, to say the least, and I think our clients are quite pleased with the outcome to date. Look, I think, firstly, this investment was made in 2013. We first met the company a few years prior, and our very first investment in a dairy business was in 2002, China Mengyo. We've been investing in China for 27 years, and the vast majority of our investments, our investment thesis, has been focused on the China consumer. And very much part of our consumer play has been, as incomes grow, a disproportionate amount of that income is directed to the child. So investments in dairy, investments in diapers. We've owned 4 diaper businesses throughout our history. Maternity care centers, kindergartens. So first and foremost, I think any investment that's performed this way needs to have the right backdrop. And when you look at the infant milk formula market, in the last 20 years, that business in China has gone from about $1 billion retail business to last year around $25 billion. And it's the single largest market in the world for infant milk formula, and it represents about 50% of the world's market. So firstly, you've got to get the industry right. Secondly, you've got to work with the right company, right management team. I think many people would know that, observers in the industry would know that in the IMF or infant milk formula market, international competitors have been very strong from the get-go, particularly in Tier 1 cities, Shanghai, Beijing, Guangzhou. Our view, and this was back in 2010, 2011, was that there would be room for strong domestic players. And the benefit of domestic players are that, first and foremost, strong entrepreneurs with the incentives of owning equity is very important in the context of value creation. But we've also found that strong entrepreneurs locally understand the customer better than foreign operators. Foreign operators in the IMF market have strong brand, right? Brand recognition and a very good product. But we thought that this market could have space for, room for, 1 or 2 or 3 strong domestic players. What caught our eye with China Fei He was during the 2008-2009 melamine scandal, this company had no products recalled. They had no products recalled because their production process was what we believe to be the strongest, highest quality product in the domestic market. And effectively, they produce their IMF formula from fresh milk rather than powdered milk. to produce milk from fresh milk is more complicated logistically. But you have more control over quality, product, and ultimately the nutrients, proteins are higher, fat contents are higher in fresh milk IMF versus powdered milk IMF. So we thought in this instance, in the case of China Fei He, that they had the right management team. Chairman Leng, I think, is viewed to be the strongest person in the entrepreneur in the IMF market, and he's supported by President Tsai, CFO Liu, and Director Tu, all of whom are exceptionally strong. We met them and invested in their company in 2013, and it was a take private from the New York Stock Exchange. We've done 7 take privates to date. And it's from exchanges all around the world. And that the advantage of a take private is there are opportunities, as you know, for arbitrage. So when we went in and affected the take private, led the take private, the PE ratio we paid was approximately 5 times earnings, trailing. And we valued the company at approximately $150 million in total. The year before we took it private, the company generated about $25 million of net income. Last year, the company reported $550 million of net income. So of course, profits increased by 25 times. First half of this year, in the middle of COVID, profits for the first half are already $400 million US of net income, up more than 50% over the prior year. So that was the biggest value creation, is profits.
Right.
And then just briefly, we did relist the company in Hong Kong, and today the company's stock trades at approximately 20 times earnings. So the value creation came from both a profit increase as well as a PE expansion, and that's how we got to the 100 times return.
So can you explain a bit about the value creation?
Yes.
So
yes.
obviously you've seen a massive increase in their sales and profit.
Sure.
Where did that come from? What did you
Yes.
do? I mean, going in, what was your investment thesis?
Yeah, so going in, maybe I would say this. Going in, our thesis was exactly as I set before, which was that this was an industry that was going to scale over time as incomes grow and more money goes to the child. We had a belief, but we were unsure of it at the time, but we had a belief that Chinese, as income grow, would direct more and more money towards premium products rather than basic products within the IMF spectrum. So one of the big drivers, and this was market related, was that premium products today, and premium products are defined as those products priced 350 RMB per kilogram and above. Those products today represent more than 40% of the market. When we invested, they were less than 15% of the market. So first and foremost, the consumer changed dramatically. Secondly, the company, and we spent quite a bit of time with the company in terms of distribution channels and the like. The company was well positioned in its tier 2 and tier 3, tier 4 cities because they were very close to distributors in all these markets. And actually during this time, working with the company, we found that channels were changing from grocery stores and typical sort of mass commoditized retailers to mother and baby stores, more specialized stores where the environment was more positive, conducive for selling premium products. So positioning the company's products for that trend towards premiumization, ensuring quality in terms of products, but their product quality has always been quite strong. And then preparing the company for this shift in channels was very, very important.
To what extent has it also gone from being essentially a brand to being a more vertically integrated dairy company?
Yes. So when it comes to infant milk formula, because you're selling a product to babies, to children, it's all about the product. Of course, branding is very important, but it all comes down to the product. And if you don't have control of your product and the manufacturing process, very bad things can happen. For example, 2008, when 20+ companies in China were found to have been using additives such as melamine to try and hype the numbers and make them look better, but actually they got children sick. So what's been very important for China Feihe is they've always been in control of their manufacturing process. They've worked very closely with a dairy farm company that operates 7 dairy farms in northern China. And today, they've now combined these businesses, or at least announced the combination of those businesses. And what's one of the hallmarks of the company's operations today is from the time the milk leaves the cow, it takes 2 hours to get that milk to the final IMF product. So it's complete control over that manufacturing process, as opposed to other manufacturers who rely on powdered milk, and that powdered milk can be shipped thousands of miles away from foreign lands, and you don't know what's happened to that milk.
Cool. Chin,
yes.
Congratulations, and thank you very much.
Thank you so much. Thank you so much.
Exit of the year mid-cap, equity commitment on entry between $50 million and $149 million. Our nominees, APM, which is Quadrant Private Equity, EMC Holdings, which is Affirma Capital, Lao Baixing, which is EQT, Modern Star, Navis Capital Partners, and Vati, which is NSSK. And the winner is EMC Holdings. So Affirma Capital was an investor in this business for about a decade. It started as a pre-IPO deal, became a controlled investment after the company failed to go public twice. Affirma eventually exited in September when SK Group bought the business for 1 trillion Korean won. The multiple is 4.2x and the IRR 26%. Tayyip Kim of Affirma Capital recorded this message.
Dear AVCJ and fellow investors around the world, this is Tayyip Kim, one of the 7 founding partners and the head of Korea at Affirma Capital. First of all, thank you very much for your recognition, and I'm very honored to accept this award on behalf of Affirma Capital team. I also want to thank my management team at EMC, who survived the decade-long journey with us. This award is particularly meaningful to me since 2020 is not just an ordinary year. In fact, we've been through so many things over the last decade. We failed IPO twice, we changed CEO more than 4 times, we took over the controlling stake and gave away our put option, we changed the entire business model, and now we are facing the global pandemic. But we never gave up. I'm thankful to my team who stayed focused and kept a promise to return the capital to our investors. We will work harder and continue to deliver the promise so that we can come back to win this award once again in near future. Thank you.
Exit of the year large cap, equity commitment on entry above $150 million. And the nominees, Velocity Frequent Flyer, which is Affinity Equity Partners, Daisung Industrial Gases, MBK Partners, ESR, Warburg Pincus, H-Line Shipping, Hahn & Company, and SBI Cards and Payment Services, which is the Carlyle Group. And the winner is Velocity Frequent Flyer. In 2014, Affinity became the first private equity firm to make a direct investment into an airline frequent flyer program. During its holding period, the membership base grew 2.5 times to nearly 10 million people. Affinity exited in November 2019 via a buyback worth 700 million Australian dollars, delivering a 3.x multiple and a 31% IRR. KY Tang of Affinity Equity Partners collected the award and stopped by for this interview. I'm now joined by KY Tang, Chairman of Affinity Equity Partners, to discuss, first of all, the exit of the year large cap category. Now, KY, you exited Velocity, the frequent flyer business, and that was one of 2 exits in Australia you did towards the end of last year. The other one was TEG, which is a live events business. Now, since then, obviously live events and airlines have not done so well. So I guess the first question is, where is your crystal ball?
Yes. It's something I keep under my pillow every night and I take up in the morning. No, I'm just joking, right? No, a lot of our LPs ask that. You must have a crystal ball. My answer is no, we don't have a crystal ball and we are not smart enough to produce the future. But what we can do now is that within Affinity, we do have a very disciplined approach to handling assets, right? For both of those investments, we've held the investment for nearly 5 years. And that will be the normal holding period for private equity. And so we came to the conclusion that 1 year before the end of the 5 years, we usually go through a process of looking at how do we exit and how do you prepare for the exits and so on. We realize that exits in Asia doesn't come about naturally. They take a long time. And therefore, you really need to have a plan and need to prepare for it. So it's all about being disciplined about the process. And we have a timeline. We kept to the timeline. It just so happened the timeline happened to match with what happens subsequently after that. So sometimes it's better to be lucky than to be smart. Huh?
Okay. Let's talk a bit about Velocity. Now, this was the first direct investment in a frequent flyer business by a private equity firm. And at that time, as I recall, a lot of the talk was about Qantas, not about Virgin. So can you take us through the sourcing and the development of the thesis for that deal?
Okay, yes. You're right to know. I think, to my best of my knowledge, this is the first PE deal involving an airline frequent flyer program. And I understand today it's still the only one, right? So it's kind of a unique, so nobody done it before. How they came about, again, same thing too, we always prefer kind of do proprietary deal rather than do auction for the obvious reasons. And so within the team itself, we go through regular brainstorming exercises as to what are possibilities. And actually, surprisingly, this idea came about from one of the young associates within the group who actually was thinking it through and they say the airlines are all going through a tough time. They seem to be going through a tough time all the time, airline, the capital constraint. And we all know, right, the frequent flyer program is in most airlines the most profitable part of the airline. And so this kind of idea, so how do we unlock it? How do we persuade somebody to unlock it? Because I'm sure many people, the airlines must have thought about it many times, yet very few of them have done it. How do we, and what is the selling point? So we went through the process, and so through help of some people, we actually approached the airline directly themselves with an idea. But the idea is more than just taking it out. There need to be a bigger value proposition, which was that you still have a major stake in it, right? Together, we will build a business to make it a lot more profitable. So the key is convincing the airline that we could make this into a much more profitable business. It could be spun off into a more independent business that has its own focus and is able to pursue its own strategy, not necessarily have to be tied down to the strategy of the airline.
Most of Affinity's transactions are control deals. In this case, you're a minority. How did you get comfortable with that?
Yeah, although it looks a minority because we own 35%, Virgin Airlines still owns 65%. But if you look through the terms of the deal, it's very much a joint control deal. There was a shareholders agreement that gave us veto power over almost every major decision. So it very much was structured as a true partnership, and it was very much a joint control deal, rather than your typical minority deal.
And so what did you actually do with the business? Because it started out as I think a fairly standard frequent flyer business, very airline oriented. You made it a much broader loyalty sort of program. I mean, what did you do to sort of get from A to B?
Yeah, okay, good. You're absolutely right. If we bought it and then make it continue to be an airline frequent flyer program, we probably would not have done it, and we probably would not be able to realize the return we need. So very clearly there was an understanding, an agreement from both sides that we would turn this from an airline frequent flyer program into a broader customer-based loyalty program. We realized that there are many industries that want greater customer loyalty, that want deeper customer engagement, and a customer loyalty program one way to do it. And so we did a number of things. So we transformed it to a broader one. That means what? That means we wanted to reduce the business from the dependence on the airline. So over the 5-year period, we took the business from nearly 60% business dependent upon the airline business towards one where it's below 30%. And then the next biggest business and the fastest growing part of the business was our business with banks and financial institutions, credit card companies, mortgage, and so on, which really want this kind of thing. But also then to move to the next sector, which is the retail sector, which is very, very big in Australia. And so we did some landmark transaction with PP, for oil and gas, gas retailing. Also with Coles, which is one of the two giants of the retail scene in Australia, and that was kind of breakthrough. And so the financial institution business became a very big part of the business. In fact, became the most profitable part of the business. So we're transforming really, into other sectors, but also into utilities, into almost any businesses where they want customer loyalty. Okay?
Just finally, I mean, what did that mean for management? Because obviously, yes, joint control, but you did have some incumbents there. And at the same time, you sort of repositioned the business quite significantly. So to what extent were there management changes?
Yeah, you did. So in the first place, for that to happen, of course, you clearly require the top management of Virgin to accept that. And they were led by a very dynamic CEO who clearly saw the benefit and prepared to give it a try, was very open-minded. And so together, with strong support from both shareholders, it was possibly done. But we need to actually greatly add to the management team. So right at the beginning, we asked together with Virgin, identify 20 strategically important positions that we need to fill. And over the 5 years we were there, we managed to fill 17 of those 20 positions. And it made a difference. It was a major upgrading of we have a new CEO, we have a new CFO, in fact, almost a new person in every one of those positions, including a major investment in technology, in upgrading the technology backbone of the company. So, and the other thing we did was to make a major investment into the digitalization of the business. We were probably one of the first of the major companies in Australia to do it, and we realized how tough it is to get started. Remember 6 or 6 years ago, there were very few people who really knew what data analytics was. There were tons of consultants who would teach you about that, but we came to the conclusion that most of them actually were also struggling to find a way through this new area. So we did the smart thing which we did was that we went out and bought a data analytics company that's been in business for more than 10 years. Already have a lot of experience working with commercial customers like Samsung and Nissan and Telstra. People who need to prove themselves in the commercial market and have proven themselves. So we bought that company and make it the in-house data analytics arm of the company and says, don't do other business. Just do the business of the in-house business, and it's big enough and it's a lot lucrative for everybody. So they really make a difference in terms of using data analytics to really understand the customer insight. It makes us so much more effective in the way we market the customer, in the way we analyze the customer, in the way we understand what the customer wants. I think it really makes a big difference to the business when we actually able to greatly upgrade the quality of using big data, data analytics, artificial intelligence in the way we deal with the customers into our technology infrastructure, but also in the way we market to our customers.
KY, thank you very much indeed.
Congratulations.
Yes, thank you very much.
We move on now to the Responsible Investment Award, which recognises outstanding environmental, social and governance practices with an Asia-based business. As mentioned before, this category is not subject to a public vote. We had a separate judging panel decide the winner. And the winner is Canvest Environment. So Canvest is a Guangdong-based waste-to-energy project operator. Olympus Capital invested in the company in 2014 through Asia Environmental Partners. And during the holding period, they've made substantial improvements to green energy output, greenhouse gas emissions avoided through renewable energy projects, solid waste treated rather than sent to landfill, and reduction in water consumption. Alexander Luay of Olympus Capital came in to collect the award.
Congratulations. Thank you, Alan. On behalf of Olympus Capital Asia Environmental Partners and Canvest Environment, I would like to thank AVCJ and the judges for giving us this award. Asia Environmental Partners is a private equity fund program that is focused in UN's Sustainable Development Goals. We're currently the third largest shareholder of Canvest. Canvest is a leader in waste-to-energy sector. In the past 10 years, Canvest has produced renewable energy that avoided over 10 million tons of greenhouse gas emissions and treated 20 million tons of municipal solid waste. Our team's been glad to work closely with Canvest's high-caliber team from the very beginning in due diligence to post-investment, setting the ESG strategy, execution, and measurement based on global best practices. Thanks AVCJ again for this honor.
Okay, the Operational Value Add Award. This recognises private equity value creation in an Asia-based business. We actually had a number of outstanding entrants this year, and so what we've decided to do is give 2 awards rather than 1. One of them to a mid-cap business and the other to a larger cap investment. In the mid-cap category, the winner is Nexus Day Hospitals. This is an investment for Mercury Capital in Australia. So Mercury combined 2 complementary day hospital operators in 2016 to form Nexus Day. Over the next 3 years, the business expanded from 6 hospitals to 15. The management team was augmented, standardised enterprise systems and planning processes were introduced, and relationships were improved with the doctors, who held a minority investment in the business, and with the insurance companies, which are the main source of revenue. Mercury sold its majority stake in November 2019 to QIC, generating a 3.5x multiple and a 44.3x IRR. Ben Horter of Mercury recorded this message.
Hi all, it's Ben Horter here from Mercury Capital on behalf of the Mercury team. Pleased to virtually accept the Operational Value Add Award for Mercury's investment in Nexus Hospitals. Nexus was a journey where Mercury brought 2 operators together in 2016 under the Nexus brand and under the Nexus management team to ultimately create the leading day hospital operator nationally in Australia. Expanding the business from 3 hospitals at the time we first introduced ourselves to Nexus to 15 hospitals nationally when the business was sold in 2019, late last year. We are pleased to have actively worked closely with the Nexus team on this journey as they did the heavy lifting to build out a very strong operating foundation from which we could continue to expand the business. And in this regard, a few thank yous and acknowledgements to, in particular, CEO Andrew Petering, who worked tirelessly and with huge conviction in Nexus's vision, supported by the whole Nexus team, not least COO Scott Bell and CFO Alex Haley, to our fellow board members, Jeff Thompson, co-founder, and Grant Snibson, medical director, who made a huge contribution to the journey, and definitely an advisor of note to Maddox, who worked almost as an extension of the Nexus team for all the M&A as the business grew. Thank you, and we wish the business all the best.
The second Operational Value Add Award goes to TEG, which is Affinity Equity Partners. Now, TEG carved out Affinity from Nine Entertainment in Australia in 2015. At the time, it was basically an Australia and New Zealand ticketing business. What they have done is transform it into the largest live events operator in Asia Pacific and the 3rd largest globally. And that was done through a number of bolt-on acquisitions, the introduction of data analytics competence, and an expansion beyond Australia into Europe and Asia Pacific. It exited in November 2019 with a 2.6x return. KY Tang of Affinity Equity Partners collected the award and stopped for this interview. Okay, I'm back with KY Tang of Affinity Equity Partners, and we're now going to talk about TEG. So, KY, this business was a carve-out from Nine Entertainment, a company which I think many people in private equity are very familiar with. What you had to do is take a business that was essentially a ticketing business in Australia and New Zealand, and you turned it into a live events business with operations, I think, in Europe and Southeast Asia as well. When you bought the company, was it clear that that's what was going to happen to it?
Yes. Yes, you're right, This is a name that's quite familiar with private equity, sometimes for the wrong reason. It was a business that's owned by a PE firm, then it went bust, and then it was bought over by 2 distressed investors, Apollo and Oaktree, which then actually restructured the business and then sold this part of the business to us. So there's got quite a history of this business. So when we bought it, it was very much a local business. Although a good local business, it was a #1 ticketing platform in Australia. So it was very much a ticketing business. It sells tickets to sporting events, to concerts, and even to museums, right? Entrance to museums and so on. So when we realized that we need to build it into a bigger business and not just dependent on ticketing. So we have an investment thesis which actually continued to be relevant. It's basically what we carried out. Of course, along the way, we added more features to that overall strategy, but the basic strategy was the same. And what was that strategy? It consists of basically 4 pillars. First one, of course, is that we got to transform it from being just a ticketing platform towards a broad-based live events and ticketing business that hopefully will expand beyond Australia and New Zealand, but towards the rest of Asia Pacific. So that, of course, is the first thing we need to do. When we bought the business, the main business was ticketing. It was a great business. It's stable, right? It's stable business. And then it's got a smaller live event business that does concert promotion and organization and tours and so on. It's a tougher business to do, and it's got lower margin because it's more volatile, huh? And so on. So we started to grow the ticketing business, and we did. And so within the 5 years of the ownership, the live event business became bigger than the ticketing business. For good reason, because the ticketing business in Australia was quite mature, right? Ticketing volume was growing only 2% a year. So you know in PE how the mathematics work, you can't get your 20% IRR out of a business that grow 2% a year, right? So we clearly had to do something else. So we realized that live entertainment was important, content was important. So the second part of the pillar was very simple, because we need to now grow that business through bolt-on and M&A. And so that's what we did. So we started off domestically by acquiring companies that has got content. So we know in this business, content is king. And content that you own is more valuable than content that you purchase from elsewhere. So within the first 15 months, we focused on the domestic acquisition strategy. We bought 4 companies, including the biggest concert promoter in Australia called 20th and so on. So that worked out very well for us. And after we did that, we have enough confidence that the management have the ability now to grow the business. So we went offshore, which kind of fit Affinity's playbook, which is we are a pan-Asian firm with operations over Asia Pacific. So the next 15 months, we went and did acquisition overseas. So we bought the number 1 ticketing and events company in Malaysia. We bought the number 2 one in the Philippines. And then we set up an operation in Singapore in order to expand our business to the rest of Asia through greenfield operation in Singapore. We know Singapore very keen of acquiring, bringing a lot of the international show, especially now that they've got a very big casino scene in Singapore, but also to places like Hong Kong and Macau, which has the casino has the same strategy. You cannot just rely on gambling. You need to make it an event whereby you got shows and so make it a more family thing. So that's what we did. Then the third part of the business to do was then to go into Europe, which we did, and bought over a company in the UK that were doing the business, so that we became a global business. So at the end of 5 years, we became the number 3 live entertainment company worldwide, which was quite a remarkable achievement. Then the fourth part of the pillar is to make the business even more valuable and more productive, was the adoption of data analytics and artificial intelligence to digitalize, to create the digital transformation of the business, and we did all that, everything, from using data analytics to help in the marketing, to make the marketing more efficient, but also more productive and more effective. So I won't go into all the details, but we have the stats to prove that the marketing effectiveness in which how we deal with our customers increased at least like 75% in terms of marketing effectiveness, and reduce our cost by maybe like 40%. So those are the 4 key pillars that we did.
I mean, it sounds easy when you say it. What were the main challenges in execution? Because especially when you're going from business which is ticketing to one which is events, where you're sort of having to put a lot more money up front to say secure this pop star to do this set of concerts. So how did you sort of deal with the risk?
Yes. So clearly we need to upgrade both the governance, but also the financial control processes and procedures within the firm, right? When they were part of a bigger group, it's easy for them because head office take care of many things. So in this case, we have to first of all carve it out of the company and make it a standalone company, which you could now build many of the infrastructure yourself very, very rapidly, right? We do that. But one thing private equity do very well, of course, is deal with the governance of the thing. but also putting discipline into financial reporting, financial control. So in order for us to step out to the base and take on more risk, we need to put in system and procedures that put more discipline, much more analysis into how we underwrite many of these financial commitments. You're right, before we came in, they were doing very small show. If ever they need to put money up front for concert, they wasn't going to put more than $2-3 million for a major concert. But when we wanted to do the international concert, when we wanted to bring in a Taylor Swift, a Katy Perry, a Bruno Mars, which is what we did, right? Or Adele and so on, into Asia, you got to put a lot more money up front on the thing. I'll give the example, one international star we mentioned, and we kind of guess who it is. To get her to come to Australia and do 16 concerts, we have to guarantee her that when she leaves Australia, she will have not less than 70 million US in the pocket. Now the OTG would never do it, right? Doesn't have the capacity, but under P ownership, they have the ability to do it. But we dare to do it because we put in the underwriting procedures, the risk management methodology, and there are many things you can do to mitigate the risk and so on. But that's what PE is good at. So the good thing for them is that we benefit from having a very good management team, but they benefit from having a PE firm that has got not only deep pockets, but also has got a certain financial discipline. But also when they begin to do the bolt-on acquisition, they're working with the firm for which bolt-on acquisition is second nature to them. So I think both sides have benefited from that.
KY, thank you very much indeed.
Congratulations again, KY.
Yes, thank you very much.
I'm now joined by Oliver Stratton, the Managing Director with Alvarez & Marcel. Alvarez & Marcel is one of the judges for the operational value add category this year. So I'm going to talk to Ollie a bit about the category, about the entrance. So Ollie, were there any particular themes that stood out this year?
That's a good question. There were 2 or 3 themes that actually stood out. First one was a real sort of transformation of business models. And so what we saw, some basic businesses that were really being sort of changed through going into new channels, into new customers, new geographies, some of that through M&A, some of that through just upgrading the team. We also saw some large deals that have been done quite recently that have taken advantage of the whole situation with COVID and sort of rapidly going online. We also saw a couple of healthcare businesses in China that have really taken advantage of sort of growth in that sector, in particular sort of startups, new concepts in medicine and so on. So there were some really interesting cases that we actually looked at.
And what sort of commonalities are there with the things that you have been doing at Alvarez & Marcel? Because, I mean, part of your business, I think probably the bit you're best known for maybe, is the turnaround stuff. So are you seeing a lot of companies right now in Asia that need significant support?
Well, we certainly are, and we've had a very busy year, both on our turnaround practice and also in our restructuring practice, which is really a bit more the emergency ward where businesses are looking for restructuring of balance sheets. But what we have seen is that most of our clients in private equity world, it's been all hands on deck, focused on the portfolio. There are certainly some new deals, but less than we would normally see in the market. So it's really about looking after the portfolio, what we would call pivot to cash, so preservation of cash, keeping the business in a healthy shape and keeping going, but also thinking about longer term opportunities. And then, as I mentioned, there are some businesses that we see where it's really about taking advantage of new opportunities already, opportunities presented by this unique year.
I mean, that idea of business model transformation that you said had come up with some of the entrants for the award. What are the sort of the challenges when you're doing that? I mean, if you're a private equity firm and you're seeing that one revenue stream is drying up, but you see another potential one sort of over there. I mean, what are the challenges when it comes to pivoting?
Well, the biggest challenge is sort of change management and people. So, part of it is about, do you have the right skill sets to actually take advantage of those new skills? Do you have, the technology in place to do that? But also, how willing are you to potentially sacrifice some of your existing business? Interesting talking to some of our clients where, businesses that had, for example, retail businesses that were struggling, and have almost been forced into submission with the old bricks and mortar retail, and yet now they can focus 100% on new models of online retail. So, I mean, in some ways, the crisis has actually helped that transition happen much more quickly. But the key really is having the right talent in place. So, in order to sort of capture that.
Mm-hmm. I mean, you mentioned there were some interesting entries in healthcare. I mean, as you've said, there's been a big sort of pivot to for retail to the e-commerce channels. I mean, any other particular sector themes you're seeing right now?
Well, I think certainly, I mean, similar with healthcare, actually, that what we've seen are a number of new type models where more sort of online healthcare diagnosis and things like that, where people have not had to go to hospitals for, well, certainly diagnosis, sometimes even treatment, and so those sorts of kind of models have been things that we have seen growing very rapidly, not just in China, but all over the world. Other sort of themes that we see sort of on the manufacturing side, again, less related to COVID, but more just the general turmoil in the world, is sort of security of supply and having manufacturing located in different places. Probably less a focus on lean inventory, more focus on just making sure you've got different suppliers that you can source from in order to ensure that you're producing at the right time and at the right place.
That notion of all hands on deck that you mentioned before, what are you seeing in terms of how private equity firms are thinking about this internally? Because obviously you've got some guys that have large operating teams, you've got other guys who outsource a lot. What kind of questions are being asked of those different models right now?
Well, I think, I mean, it's really the same with both, actually. I mean, I think it's an intensity of focus of their own team, whether it's their deal team or their operating team, or really both, on the businesses that they actually own, and making sure, firstly, are people safe, and is there a safe environment? But secondly, just focus on survival. Rigorous cash management, resetting of business plans, and then, as I mentioned earlier, also then thinking about new bolt-on investments and how to take advantage of a very different world. But whether it's outsourcing for outside consulting firms or doing it in-house, I think it's that intensity of focus. And just, again, given the maybe more limited new investment opportunities and the ability to go out and source opportunities, particularly with funds that don't have teams in country, then that's what their teams are focused on right now, is the portfolio and coming up with plans that are realistic and are well funded.
Ollie, thank you very much.
Thank you, Tim.
We now move on to the Firm of the Year categories, and we begin with Firm of the Year Midcap, which goes to a private equity firm with assets under management below $5 billion. And the nominees are Advantage Partners, Ascendant Capital Partners, Newquest Capital Partners, Chiming Venture Partners, and Quadrant Private Equity. And the winner is Advantage Partners. Last year, Advantage became the first Japanese private equity firm to address succession planning in a significant way, with the sale of a minority stake in its management company to Tokyo Century Corporation. Advantage also closed its sixth Japan buyout fund at the hard cap of 85 billion yen. It made 9 new investments, and it completed its exit from FMI Corp, among others. Richard Folsom, representative partner with Advantage, collected the award and stayed for this interview. Okay, I'm joined by Richard Folsom, co-founder and representative partner of Advantage Partners. Richard, thank you for joining me.
Thank you. Pleasure to be here.
So I want to talk a bit about what Advantage has been doing over the past 12 months. But let me start by noting this is not the first time you have won the Firm of the Year award.
Okay, sure.
The previous time, I believe, was 2008.
2007 or 8, I think it was, so, yes. Yeah.
After which not everything went right for anyone, really.
Yes.
So are we tempting fate?
Well, and I wondered that myself with the Madden curse, which is in the States with the football game. But hopefully that's not the case. Hopefully this time around it'll lead to a string of better activities for ourselves. Because yes, we did run into some difficulties after the global financial crisis last time around, after a very good year of activity. And it's taken us a while to get back to this place again. And I think in that context, the meaning of this award this time around, I think, has a lot greater significance and meaning to our firm, I think. Obviously, they don't know about it yet. I've just found out myself, but I'll be sharing the news, and I'm sure everyone will be quite pleased.
I mean, obviously, Advantage has evolved significantly since 2008. I mean, you now have a sort of a Pan-Asia fund as well as a Japan fund. You have a public markets fund.
Yes, yes.
And also, last year, you took a sort of first step in succession planning. Can you sort of talk us a bit through that? Because that's still quite unusual for a private equity firm in Asia.
Well, indeed, and I wouldn't say in our context and the way we're thinking about it that last year was a first step. We've been in a process that's probably been going on for 5 years and will probably continue for another 5 years. That's a number of steps that are moving in that direction. But I think you're alluding to something that's involved in the ownership and the capital structure of the firm, having brought in an outside sort of strategic investor and as a minority investor in Tokyo Century, who's joined us, and then also transferring ownership of 20% of the firm to the non-founder employees of the firm. So 2 steps in the ownership structure that have taken place that are a piece of a bigger transition in terms of how the firm is governed, how investment decisions are made, how the firm is owned, that we're transitioning to a broader group of partners and professionals in the firm. So the idea being that the firm would long outlive the founders.
You closed your latest Japan fund earlier this year. You're one of a number of Japanese GPs that's raised money. It's one of those markets that seems to be defying COVID. What is it about Japan right now?
Well, I think it is, in one sense, it's the same old, I mean, it's the same story that has really just continued quite steadily and moderately for quite some time. And I think we're seeing people recognize that there are sort of constant, steady deal opportunities in Japan with very steady and attractive returns. And there is some wave and cyclicality to that as well. And I think there's some expectation that, in addition to sort of an underlying secular set of deal opportunities with founder owners, but also now the carve-outs from large corporations is sort of entering another wave where many of these deals, I think, are more accessible to private equity this time than perhaps in the past. And a lot of that has to do with, I think, the results that private equity has shown to the business community in Japan, where I think people recognize that private equity generally have been very good stewards for businesses and done well with those businesses, and that's, I think, positive for the development of the market and for penetration of private equity further into what is a substantial M&A market in Japan. Private equity still being a very small piece of that, maybe plus or minus 10% given each year. So there is room for more penetration. I think there's some indications that that's going to continue.
Mm-hmm. Regarding the carve-outs, and obviously over a number of years we've seen various people talk, we've seen various initiatives. Obviously there's a greater focus on the governance side. It's almost like people are saying to Japanese corporates, it's okay not to be really big as long as you're better performing. Mm-hmm. You mentioned that there's also a greater acceptance of the role private equity can play. Can you elaborate on that, specifically with the corporates?
Well, specifically with corporates, well, I think certainly facilitating consolidation in industries, which is sometimes very difficult with corporate situations where there's excess capacity and different parents have different subsidiaries and divisions. I think we can help facilitate some of the consolidation and some of the capacity adjustments that need to take place. Certainly on the governance front, I think private equity has proven to be very good in terms of sort of bridging that sort of distance from shareholder to management to employees and really shrinking that so that there's better communication, better understanding of what's important to stakeholders and shareholders and how to implement things within an organization that perhaps has been a little bit lost over a long period of time in many Japanese corporate settings. Certainly a lot of the government initiatives that have happened over the last 5-6 years with reforms in terms of requiring more outside directors, focus on ROE, some of the stewardship and governance codes have highlighted that, and companies that are really, I think, sincere and serious about doing that have taken those measures and then recognized that private equity can be helpful in those situations where they maybe have divisions or subsidiaries that they would be better off letting go and taking those resources to focus on some things that they want to remain competitive in.
Richard, thank you very much indeed.
Okay, sure, thank you.
Congratulations.
Thank you, thank you. It's a great honor, and we're very pleased and surprised by this recognition and this honor. I don't know what to say. I think everyone at our firm is going to be very pleased and very happy about this, particularly in the tough environment we're in, some of the great things that we're seeing happen with our firm. Thank you so much.
Congratulations once again.
Thank you.
Firm of the Year Large Cap, and this is for private equity firms with AUM of $5 billion and above. The nominees are Hahn & Company, KKR, MBK Partners, Sequoia Capital China, and Warburg Pincus. And the winner is Warburg Pincus. Over the past 12 months, Warburg Pincus has realised $2.5 billion from investments in China and Southeast Asia, and it has also put to work another $2.5 billion. Notable activity includes logistics real estate platform ESR, listing in Hong Kong, and that accounts for the bulk of the distributions. They also had an IPO for Hygeia Medical in Hong Kong. New deals in China included participation in the $8.7 billion take private of 58.com, and there were growth capital investments in Perfect Diary and Haihe Pharmaceutical, among others. In the Philippines, Warburg Pincus invested $225 million in broadband provider ICT Convergence. Julian Chung collected the award and said a few comments, and then Jeff Perlman recorded this interview. Okay, Jeff, thank you very much for joining me. Just want to do, I guess, a bit of a recap of Warburg Pincus over the last 12 months. And obviously the standout development really was the listing of ESR, and that was an investment that you were involved in from the very beginning, which would have been, I guess, nearly 10 years ago. Can you sort of tell us a bit about that? I mean, so when you sort of made that first investment, what were sort of the expectations, and to what extent was the result in line with those?
Yeah, you're right, Tim. I mean, it's been 10 years basically when we first conceived ESR, and I think what's so rare about an opportunity like ESR was it's a business that we co-founded alongside the two entrepreneurs when we started back in 2010, 2011. And I think what probably surprised us a little bit was the vision was to kind of create the leading Chinese logistics real estate platform. But because of the success we had in China, our ambition started to grow over time. And then it became, really an opportunity to try to create, the leading Pan-Asia logistics real estate platform. And, it's obviously played out above even our own, wildest expectations, and a real credit to the entrepreneurs and the management team for what they've been able to achieve with the business. But as we sit today, we've got AUM of over 25 billion, a market capitalization for the company now north of 10 billion US dollars. I mean, stock's up over 50% since the IPO. So really, it's been a tremendous, tremendous story.
You mentioned not expecting it to become more than a China market leader. So that merger with Redwood, was that never part of the plan?
It wasn't part of the original plan. Again, before you always say, you want to crawl before you can walk. And our view was, look, we really needed to create a leading platform in China first. Once we did that, we really felt that we had the ability to go beyond China. And actually we went to South Korea first. And that ESR Kendall Square platform has emerged as the dominant platform in the market. I mean, I think we have AUM now approaching $8 billion in Korea. And then the next was, if you wanted to be a big player, certainly in Asia, Japan was such an important market. And that's really what led us to assess who were the best players in Japan, because we always wanted to back the best local team in each market. And we really felt that was Redwood, which led us to the discussions with the Redwood founders.
And how was it different expanding into those other markets? Because I get the original premise of the China investment in that you had this expectation of a massive increase in e-commerce business. All that stuff would have to be delivered, and you didn't have the modern logistics there to do it. Presumably in Korea and Japan, it would have been a bit different.
You know, it was a bit different, but the synergies in the business, I always said, were twofold. One was on the tenant side, and as we started to grow a funds management business, it was also on the capital side. And so if each of those, whether it was a tenant or the capital partner, could underwrite one platform and help us to solve their needs across multiple geographies, it would be a huge game changer for them. And so that's what kind of played out. Many of our tenants, again, whether it was H&M, you know, they were operating not just in China, right? They're operating in places like Japan, in South Korea, and elsewhere. Obviously, it's now, we've seen it on the e-commerce side. We're the biggest landlord for, you know, groups like Amazon. If you look at, obviously, Japan, we were in China, and now they're doing stuff with us in places like India, and so forth. So this was really the synergy, and it's happened on the capital side, right? I mean, big pension funds like APG, GIC, sovereign wealth funds, and others, you know, they're working with us across multiple markets. And that's the benefit of the type of platform and the scale that we offer both the tenants and the capital providers.
Were there sort of any moments in that journey where, you know, you ended up sort of questioning yourself or wondering whether it could achieve what it was supposed to achieve?
Look, I think you always question yourself. It's a great question. Certainly we did at various points in time. Do you take something that's already so successful in China and do you kind of roll the dice? You know, sometimes you say, do you split a winning hand if you're thinking about kind of blackjack? We thought about the same, but we really felt that we had talented entrepreneurs and management team, and we felt like we had something that really could go beyond just a single country. And that bar is very high for us institutionally. But we felt that they were ready. And, you know, that gave us the conviction alongside of their own conviction to go and pursue that Pan-Asia path. But I would say that was certainly a very important question that we had to kind of answer for ourselves. Another was, do we go from asset heavy to asset light on the funds management side? We made that decision as well, which I think has proven to certainly be the right decision. And look, at various points in time, not everyone understood the story, and you know, there may have been single points in time where it was a little tougher to raise kind of capital. But it's just amazing to see that kind of evolution as time has gone on, from where we initially borrowed money at to kind of where the company does today as a listed company. I mean, it's really a tremendous story.
I'd like to now turn our attention to investments you've made over the last 12 months in Southeast Asia, which is now your area of focus. You invested in Converge ICT, a Philippines-based broadband business, and in Circles Life, a Singapore-based mobile carrier. Obviously, it was interesting you mentioned the asset heavy versus asset light thing with ESR. I mean, obviously with those two investments as well, one of them is asset heavy, one of them is asset light. Can you sort of take us through the thinking behind each of those?
Yeah, no, look, I think the thesis behind both are certainly quite different. And we always think about the local market when we're you know, putting together our own thesis around the investment. But starting with Converge in the Philippines, for us, it was kind of, you know, clear as day. You have a population that spends more time on the internet than any other, you know, country in Asia, combined with the slowest internet speeds of really any place in Asia. So we felt that really had a recipe for us to be able to come in with and help to support, you know, Converge as the challenger to the duopoly, the existing duopoly in the market, to really invest in what's needed to deliver that fiber broadband to the masses. And so we really thought that that was the right way to play it. You know, you can generate opportunistic returns with kind of infrastructure-like investment. We like that risk-reward proposition. And that's what led us to make that investment in Converge. And, you know, I think one thing that we're so proud of is the ability to, in one kind of, you know, year, I guess, in review, that you kind of make the investment and you have the most successful, I mean, the largest IPO effectively in the country. It's a pretty remarkable journey in a short period of time. So that was really the thought process behind kind of Converge. Circles, we look at it quite differently in that if you look at the telco landscape, again, they're so capital intensive and they're like naval ships in terms of being able to kind of move and making their business decisions, changing their plans. And our view was, if you can think about it from a technology enablement that exists today, and if you had that proprietary telco stack where you could plug into their infrastructure and deliver a much better customer experience, we felt that that kind of goes beyond any individual country. Certainly they started in Singapore, but the business has expanded now well beyond that to obviously Australia, Taiwan, and kind of other new markets. We also felt that there was also another business embedded in this, which was a potential SaaS business as well, a B2B business, because of that proprietary telco stack that they had developed. And already we're starting to see meaningful traction on that front as well. So really two different views in terms of the opportunity set. But again, you have to really localize that perspective when we're evaluating opportunities.
Mm-hmm. I guess the one thing all those three investments we've discussed have in common is you partnered with local management teams in order to sort of bring them to fruition. Would it have been possible to access those opportunities without going into those sort of partnership deals?
Look, I think our mindset and mentality has always been to align with best-in-class entrepreneurs and management teams. I think, we think the combination of what they bring each and every day to the business, the vision, the execution, alongside of, I think, our strategic vision, the ability to kind of assist and bring resources that are needed to those businesses. And then ultimately, I think what we've done, hopefully as well as anyone, or even better, is really thinking about how to position the company eventually for the capital markets. And not just to have maybe an IPO, the key is to have a successful life thereafter as a public company. And I think ESR is a great example of that right now. The stock's performing because of, I think, investors see the long-term potential backed by very strong execution so far. And that's really, really important to us.
Okay, I think that's everything I wanted to cover. So thank you very much indeed.
Congratulations.
Thank you so much. It is our great honor to receive the Firm of the Year award. We're very grateful to be part of this legacy that we have all created here. I remember 20 years ago, the private equity and venture capital industry in China and Southeast Asia was tiny. I remember actually reading the Asia Venture Capital Journal to prepare for my interviews at Warwick Pincus 20 years ago. I could have not imagined that we would raise $9 billion to invest in these markets last year. We are also very grateful to be at the frontier of private equity investing in these markets. Look at the Chinese consumer. I remember one of our first consumer deals 20 years ago was a Chinese ceramic toilet manufacturer. And this year we did hire in Perfect Diary, which is a biotech and online cosmetics company. Or 58.com. When I invested 10 years ago in the Series C round, the company barely had $10 million of revenues. In this year, we did an $8.7 billion take private from the US, the second largest of its kind. And we continue to set new records in Southeast Asia with the largest IPOs in Vietnam and this year with Converge in the Philippines. Most of all, I would like to thank my team, my co-head Frank Wei in China, Jeff Perlman in Southeast Asia, and the broader team that now stands at 200 people. This industry recognition is all yours. And equally, I would like to thank our friends and industry partners who've supported our work all these years. We look forward to more growth and adventures together. Thank you very much.
Congratulations.
Finally, we have the AVCJ Special Achievement Award, which recognizes an Asia-focused investor who has distinguished himself or herself over a long period of time in facilitating the growth of the private equity and venture capital industry. And the winner for 2020 is Lip-Bu Tan, founder and chairman of Walden International. Lip-Bu is best known for two things. One, being the father of the VIE, or SINA model, which facilitated a lot of offshore investment into China's technology sector. He's also known for his long association with SMIC, which listed on the STAR market earlier this year. And that is part of an equally long interest in the semiconductor industry. From an AVCJ perspective, Lipbu was also one of 3 VC investors that seeded AVCJ when it started in the mid-1980s. Walden began in 1987, and it is an early investor in a number of companies that have gone on to define their markets, and these include Sina, Mindtree, Wuxi Little Swan, and Mindray Medical. But there is that strong association with hardware, which is timely, given the renewed emphasis we are seeing now on IT infrastructure, semiconductors, and cybersecurity. Lipbu recorded this message.
I'm very honored and humble to accept AVCJ Special Achievement Award. I founded Walden International in 1984. My goal and passion is to support entrepreneurs by providing capital, network, and experience to fulfill their dream to build great companies. After 36 years, I'm delighted that we have 115 IPOs and 85 successful trade sales. Asia is a very big part of Walden International strategy and our success. I'm extremely excited about the investment in the future, especially with the 5 generation waves, 5G, industrial automation, Industrial 4.0, AI machine learning, hyperscale infrastructure scale out, and autonomous driving. And I'm very honored and thank you for this recognition, and I wish everyone and your family well and healthy during this pandemic.